Wings2Fly and Elimu scholars from Central Kenya have been advised to choose their individual purposes and goals in life and chart their route to achieve them. This was said by Equity Group Director of Finance, David Ngata, when he spoke to 1,300 scholars gathered at Baricho Boys High School in Kirinyaga for the event organized by Equity Group Foundation. Ngata told the scholars attending the 2023 Annual Education and Leadership Congress to ensure they do not deviate from the path that would lead them to the fulfillment of their purposes.
A mind is a terrible thing to waste. And that is why Equity Group, Equity Foundation, the government through the Elimu Scholarship has chosen to invest in you based on your performance, stellar performance that you had 3 years ago, 4 years ago for those of you who are in Form 4. You will go nowhere without discipline. So be disciplined, and especially self-discipline. Small things repeated over time make a big difference.
The scholars were urged to be self-disciplined, to be safe, adding that they would be rewarded by the power of compounding proportions to become leaders with values in the long run.
In your life as students, you have the whole entire world open to you. Things don't just happen. Things are made to happen. And the person to make things happen in your life, firstly, it's you. The community will come afterwards, your teachers will come afterward, but you have to be persistent.
The Form 3 and 4 students attending the Congress were reminded not to rest on their laurels, as past performance is only an indicator of potential. The Congress was held under the theme, The Power of Purpose, Aligning Values and Leadership, and involved speakers invited to interpret it to the scholars.
It is through the management of the Wings2Fly program that the government of Kenya saw the wise management that it decided also to bring on board Equity Group once more to manage the Elimu Scholarship. We want to appreciate and acknowledge the contribution that you've made not only in the business world, but also in mentoring our young people, taking care of their needs, academic needs, that they would otherwise not have gotten if it were not for your intervention.
You've been given an opportunity by the government of Kenya, by Equity, so that you can be able to realize your full potential.
Personality greatly affects your career and how successful you flow in your career. Personality will determine a lot the kind of a person you become. Don't tell me you want to become a lawyer and you don't like speaking, unless you will become a lawyer to assist in research.
You have been given an opportunity, and opportunities comes only once. Not many times it repeats itself in life to change your future.
At the close of the Congress, the scholars expressed their appreciation for the mentorship to remain true to the cause.
One of the things that I've learned is what to consider when choosing a career. Like, for example, we have been told about personality. Like, personally, I'm interested in helping others. So I'm really passionate about it, and I want to be a doctor so that I can help others.
I want to become an aeronautical engineer. And I've learned from this Congress that my career, it comes with the capabilities and interest that I have in order to pursue that career. I have all the interests of becoming an aeronautical engineer, and I believe I will.
What I've learned is about factors to consider when choosing my career, and the most important one are personality, interest, and abilities. And right now, whatever I had made my choice to be my career, I have to change because I didn't have an interest in it.
I had many courses, but from my interest and abilities, I have concluded that computer science is fitting into me.
Inuka na Equity.
My name is Munir Thabit Suleiman, the CEO for Grain Industries Limited. We are manufacturers of flour, both maize and wheat. We are the biggest wheat miller in the country by capacity and market share, producing 2,250 tons a day of wheat and 400 metric tons a day of maize. The only mill in the country that is ISO 22,000 food safety certification, together with ISO 45001 occupational safety certification, together with ISO 14001 environmental certification, and the only mill in Eastern Central Africa that has a fully fledged microbiological lab that is able to detect the various toxins, aflatoxins. The ISO FSC 22,000 food certification is actually you've got to go through a very grueling experience whereby everything is documented and everything is monitored. And that level is easier as a result of our investing in automation. You see, the lesser number of people you have, the lesser the contamination and the lesser the mistakes. The grain is not touched from intake up to when it is in the packets. We actually are the only millers in this country who are now supplying to KFC Kenya, KFC Uganda, KFC Rwanda. This is Kentucky Fried Chicken, because they were happy with our standards. They actually used to import the flour from elsewhere. I'm also the board secretary of the Cereal Millers Association. All millers in this country have an association, and the association is the Cereal Millers Association, where we look and lobby for issues pertaining to the milling industry. Ajab is the product that actually is a household name in this country. And it was done after a survey where we realized that being sub-Saharan Africa, it's not every household that has a mixer. And so kneading the dough is done manually. And so it was good to have a blend of a product that actually helps the mama. Multi-purpose products that would fit in from chapatis to samosas to what have you. We work with various distributors, wholesalers, sub-wholesalers, Horeca, that is hotel, restaurants and cafes and eateries. We also deal with bakeries, so we do also supply to institutions directly. Our journey with Equity started from inception, because we knew that to have a very good product, you actually needed to partner with somebody who understands your business, with somebody, a stakeholder who will walk the baby steps with you from inception, and a stakeholder who will grow with you. And we found those qualities with Equity. And so Ajab and Equity started the baby steps, where when we started, we were just doing 750 tons. We were not the biggest wheat manufacturer. But within 48 months, that partnership has turned into fruition of being the biggest wheat miller in the country. And we are glad that we chose a good partner who will grow with us, and we continue to grow. Like bill stabilization. Bill stabilization has a very big advantages in that it cuts your costs insofar as letters of credit is concerned, and you move much faster with speed, and it's a trade finance instrument that actually facilitates international trade. And so by having a bank that has international correspondence and is able to actually access the dollars and facilitate your trade, allows you to be an international player. There's also retail financing, and this is being rolled over countrywide, where they don't have to struggle to stock their shops, resting assured that equity pays us immediately and then the customers pay equity later on.
Initially, they started at a capacity of 750 metric tons per day, and within 2 years, they had increased that capacity to 2,250 for wheat and another 400 for maize. We also have pay with equity with their retailers and their distributors. So we can say that they consume almost all our products, and their top management also bank with us. Credit cards, the company credit cards, they're operating throughout the country. They're not just in Mombasa, and they are big in terms of their mass or even their capacity.
There was also asset financing, which is also a critical part. Mind you, to do a distribution, you need the products and the means to deliver that. And so you need a massive fleet. And you want a stakeholder where you're able to move with speed to the last mile. And Ajab found equity to be that partner that can actually deliver that. We do source our wheat from international market, of course, plus locally when they're harvesting in the Narok and Eldoret areas. For the maize, Kenya is a maize deficit country, and we actually now are sourcing it from both Tanzania and Zambia. To the mamas, aflatoxin is a carcinogen, and Ajab is the only brand that actually has a toxin-safe thumbs up sign. As you think of your children, as you think of your family, think Ajab, because it's the brand that is easy to need, gives you more, and at the same time is safe.
Inuka na Equity.
My name is Naren Sokhi. I'm the Managing Director of Kenya Coach Industries. Kenya Coach Industries, better known as KCI, is a very well-known brand name. We are a Isuzu dealer and a bodybuilder. We are in the business of supplying commercial vehicles to the entire Kenyan market. We are the only gold certified dealer in the whole of Africa. That means we have a gold standard of service to our customers. KCI started in the year 1970, and we moved to our Addis Ababa Road premises in 1990, which is when the operations as a Isuzu dealer started. And we were there up till 2018, and we moved from our Addis Ababa Road premises to this state-of-art facility located off Mombasa Road in 2018 June. We have employees around over 100 directly and an equal number indirectly. So total we would say that we are providing a livelihood to maybe 200 or more people. We serve a very wide spectrum of clientele. This ranges from schools, institutions, corporate, SMEs, all the vibrant sectors in industry. We are a well-known brand to them. The most unique part of the motor trade industry is our matatus or manyangas, or better known as now ganyas. And you see them as a very colorful buses operating on the roads with sometimes the latest music being played at large volumes. But they are popular with all people, and they provide an essential service. So we are the market leaders in this, head and shoulders above anybody else in the market. As a client, you come in and you want to buy a vehicle, we will then get your particulars, give you a quotation, try to understand what type of design you want, and then we go to a financier like Equity Bank and try and get finance for you. And once we have the finance, then we are able to allocate you a chassis, take it through the bodybuilding process. You can come at any time and see the progress and make sure that everything is being done properly. And then once the vehicle is ready, it's taken through inspection. It's made sure that it complies with the KS 372, which is the Kenya Bureau of Standard for PSV vehicles. And then we register the vehicle, get the release from the finance company, to make sure that all the documents have been signed, and then we give you the vehicle. One of the unique things with Equity Bank was that in the initial days, they were one of the very few banks who allocated an account relationship person here to make sure that any client that we were financing through Equity Bank, their paperwork, their documentation got done in an efficient and seamless manner. And we would like to keep on working with them and keep on helping them to serve their customers, to grow, so that on one side Equity provides the funding, we provide the vehicle, and by putting the two together, the client makes money, we provide a living and a sustenance to the employees that we employ, and Equity Bank is able to go and help other customers.
Hello? Yes? Naongea na nani? Ati Rachel? Kutoka Equity? Mna activate app? Okay. Ati nikutumie kodi yangu? Ai, we hapana. Ujaona Equity wakisema tusitumie watu kodi. Ni wakora kama nyinyi mnataka kutukon. Hello? Hello?
Equity only calls you from one number, 0763 000 000. Do not engage callers from other numbers claiming to be Equity staff. Do not share your PIN, code or OTP with anyone. Forward suspicious messages or phone numbers by SMS to 333 for free. Kataa utapeli. Usikubali kuchezwa.
My name is Virginia Etonga, the principal Alliance Girls High School, a national school, one of the first 18 national schools. It's situated in Thogoto, Kikuyu sub-county. We were invited for a launch at Alliance High School, where we met Equity Bank, which had sponsored Alliance High School. A good project, and I also encourage that program and project in our schools. Equity, we are ready for you as well. Then from then we contacted Equity Bank, and they took us through the whole process of how we can also convert our kitchen from firewood cooking to gas cooking. They exposed us to several contractors and suppliers, and today we use the LPG gas in our kitchen. We no longer use firewood. We have had the LPG since 2021. We are coming to almost 2 years now. We have used it actually for 1 year and 3/4 of the year. LPG cooking has many benefits. First and foremost, we have done away with deforestation. That is one, and quite major. Then our kitchen is extremely clean, such that our cooks no longer cough just because of smoke. And the first 3 months, we realized that in the worst month, we were saving about 60,000. So if you multiply 60,000 per month for 3 months, That's all 180,000. If you multiply for 3 terms, you see it's going to over 500,000. And so we realized that that money could be used to do another project in school, or we could use the same amount to support needy girls who could not pay their fees.
Now my staff don't wake up as early as they used to. They used to wake up at 2. Now they wake up at 3:30 a.m. because now the gas east the work road, and we find it more efficient to use the gas compared to firewood. We used to scrub the filters and the hood twice a term. Now we only do it once on crossing the school. Then we used to scrub to remove the soot, which was being brought about by the smoke, the firewood. And still we used to scrub the walls, which we now don't do. We only do at the end of the year. We don't stay longer in the evening because of the work. We only stay because we are waiting for the students to come and serve their 10 p.m. tea.
We used to use a lot of time serving students, but these days we are able to serve them in less than 30 minutes. They are done and they are gone to their studies, that is in the classrooms, where they concentrate in their academics. When you're using firewood, we will have the suppliers bringing in firewood that is not dry, so you'll have to spend a lot of time calling them so that they can come and cut them into smaller pieces, or they add more firewood that is dry, and that one will be wastage of time. But these days we have 2 tankers, each 2 tons, so we have 4 tons. The current suppliers that we have are very efficient, and I'm sure if I have the 2 tanks full, in 2 months I will not have any issue of following up the suppliers.
We are in partnership with Equity, and we've been planting trees where initially the trees were cut. We've done a lot of afforestation. We planted over 5,000 trees. It feels very satisfying, and you feel proud that you are part and parcel of a transforming group that is advocating for greener environment. We are also advocating for use of green energy.
Overall best bank in Kenya 2023 goes to Equity Bank. Whoa! Congratulations!
Equity emerged as the overall best bank in Kenya for the 12th consecutive year at the 2023 Think Business Banking Awards Gala held in Nairobi to recognize and honor excellence within the banking sector.
And the best bank in Tier 1 goes to Equity Bank.
Equity also emerged tops in 13 other categories, including Best Bank in Tier 1 category, in mobile banking, in customer centricity, in retail banking, in trade finance, and the Special Judges Award for Product Innovation. Additionally, Equity also led in internet banking, SME banking, agriculture and livestock financing, agency banking, product marketing, in digital banking, and the environment, sustainability and growth ESG category.
Witnessing Equity being declared the overall winner in the Nick Business Banking Award 2023. This is a demonstration that Equity Bank, we are living our purpose of transforming people's lives and livelihoods, and that's why we have won quite a number of awards, cutting across the best retail bank, best in agency, best in agriculture and livestock financing, best in SME, best in digital banking, best in mobile banking, amongst others. and also in ESG. So we are very grateful, and especially to our customers who have stood with us.
There is a huge trust vested to the brand of Equity for deciding to choose that it is a preferred bank. So essentially it is a voice from the customers. They voted, it's the most preferred bank in the market.
The best bank in agriculture and livestock financing goes to Equity Bank! Oh my goodness.
The bank's support for agricultural and livestock sectors was acknowledged with the Best Bank in Agriculture and Livestock Financing Award. The award's judges said they were impressed by submissions highlighting what the industry is doing in environmental and social governance and seeking to expand footprint in the region.
The submissions reflect the continued excitement banks have for their business and their achievements, and demonstrate that the industry continues to innovate, transform the way they meet customer needs. Indeed, it was very impressive to see the number of submissions highlighting what the industry is doing on matters relating to environmental and social governance, as well as addressing needs like mortgages, mobile banking, and seeking to expand our borders into the region.
And the winner, my goodness, the winner, most customer-centric bank goes to Equity Bank.
The bank's dedication to customer satisfaction propelled the bank to win the coveted title of the most customer-centric bank. The bank excelled in numerous categories, demonstrating outstanding performance across sectors.
We innovated, we diversified, and we grew. We helped our customers achieve the biggest and best rewards they could, in line with our purpose, which is transforming lives, giving dignity, and expanding opportunities for wealth creation.
It's actually a validation of the market, I would say, that our customers, the markets we serve, see the value that we deliver and completely differentiate us from the others.
Put your hands together for, I don't want to go another name, Equity Bank of Kenya. Come on! Special Judges Award for Product Innovation, Equity Bank.
Equity also clinched the Special Judges Award for Product Innovation. The award acknowledged the bank's contribution to clean energy access through Equity Group's foundations, Energy, Environment and Climate Change pillar.
For the first time we won the Special Judges Award for Product Innovation. And this is the entry that we did on our innovations around clean energy, especially the work that the bank is innovating around transitioning schools from using firewood to more cleaner sources of energy, and the financing and the supply chains around that.
Equity secured first runners-up and second runners-up positions in 5 categories, including Best Bank in Sustainable Corporate Social Responsibility, Best in Corporate Banking, Best in Asset Financing, Best in Product Innovation, and Best in Mortgage Financing.
It's a sense of responsibility that we have toward the society, that we need to continue really playing the big role in the market because the vision and the mission, as I said, the purpose is big, of transforming lives, giving dignity and expanding opportunity of wealth creation by supporting SMEs. So basically we are creating wealth in our economies, in our country, which will help our economies to get out of poverty.
Today was exciting because it was an opportunity to witness the impact that Equity Bank Kenya has had in the community. The awards that were received by the Equity Bank Kenya are a testament of the confidence that the customers have in Equity Bank, on the various products that they're providing, of their technology services, of the technology rails, and particularly things like agency banking, which confirm that Equity is present in the community and is willing to go the extra mile to ensure that every Kenyan or every East African has access to banking solutions.
It's a manifestation of the work that has been done in technology and ensuring that we are able to deliver good products and services, superior products and services for our customers to be able to serve them better.
The bank's dedication to leveraging technology, fostering financial inclusion, and nurturing long-term relationship with its customers has solidified its position as the leader in the Kenyan banking sector.
Here is your mokimo and a fried egg.
I think you mixed the orders. I asked for some chips and chicken.
Sorry, madam. In this restaurant, you get what we give you, not what you want.
Oh.
Most loved brands by women in Kenya. Proudly brought to you by BST Group and Ipsos. And here's the top 5. Number 5. Naivas. Number 4.
Equity Bank. Equity has been voted the most loved bank brand by women in Kenya for the second consecutive year. The bank was ranked 4th overall after Safaricom, M-Pesa and Airtel in the BST Group Top 100 Most Loved Brands by Women in Kenya consumer market survey carried out by Ipsos. Speaking at the unveiling of the survey, BST Group CEO Eva Moraya said, "The outcomes in the report are not just good to know, but necessary for policy makers to address women inclusivity backed by data."
This idea now has revolved around an understanding of women markets and morphed into a tangible study that unpacks how Kenyan women are driving purchase decisions as primary shoppers in their households and beyond. The data that is being gathered, courtesy of this initiative, is really instrumental in determining the future of Kenya and indeed the region that is East Africa.
By publishing this study, we hope to raise awareness about the fight for gender parity and inspiring support for brands and organizations that help women globally. We're giving insightful data on women love for brands and recognizing those that stand out for the female consumer.
The chairman of the Nairobi Securities Exchange, Kiprono Kitoni, called on brands to invest in what women want because 85% of purchases decisions in a household are made by women.
This initiative is critical and seeks to highlight companies that have continued to inspire trust and confidence from Kenyan women and by so doing contribute to better financial performance from their respective companies. Women and the female influence have always been essential factors within which most successful brands, not only in Kenya, but on the world stage, are built. It is because of the growth in the power and influence of women.
Brands are expected to communicate more effectively with female audiences because by 2028, 2/3 of global consumer spending will be led by women.
I'm glad because here I'm holding the prize recognition showing that Equity is the best bank brand loved by women in Kenya. This is just a testament to the corporate philosophies of the bank and what the bank believes in socio-economic empowerment and especially for women. It's a privilege for all the ladies within the bank, but also all our staff, because it means we are doing something right and the market is recognizing it, and most importantly, the women are recognizing it. We are aligned to the women clients. When I look at what was said about the distributorship channels, I believe this was also because we are reachable and accessible. When you look at our agent distribution, it's the shop out there, and this is very accommodative to women who will always be the ones influencing the purchasing decisions.
Kazi yetu inaendelea, kazi ya kupanda nini?
Equity Group Foundation's Environment Pillar and Equity Embakasi branch joined the National Police College General Service Unit GSU Embakasi B for a tree planting exercise at the college. Indigenous and exotic tree species were planted and recruits allocated a tree each to adopt and care for during the training period.
We are privileged to have Equity Bank for the exercise of tree planting.
And this is in response to the presidential call that we need to plant 5 billion trees in the next 3 years. We have had 8,000 trees that they have been donating to us, and we have planted them as from early last year, and they are doing very well. The institution has a borehole supplemented by water from the Nairobi Water and Sewerage Company, ensuring that trees are watered every now and then to ensure that their growth rate and their germination rate is high.
Equity was acknowledged as a strong advocate for a greener environment and has continued its mission of planting trees.
We want to also take this opportunity to thank Equity Bank as a partner and as a friend of the institution for the continued support that they are supporting us in ensuring that we make this institution green. It is out of trees that we get timber, shade, fruits.
Equity's efforts in tree planting have surpassed the 21 million mark nationwide, thanks to strategic collaborations and dedicated partners.
We chose to partner with Equity Bank because Equity Bank has been our client, giving some beneficial financial management to our institution, our staff. It has made them grow financially.
Equity has partnered with Sifao Group to finance tractors for mechanization of agriculture in alignment with the Africa Recovery and Resilience Plan. Equity Group Director of Investor Relations Brent Malahe said the plan aims to create wealth on the African continent by supporting smallholder farmers.
This forms part of a bigger strategic initiative that Equity Group has in terms of its Africa Recovery and Resilience Plan, where it has 6 pillars. The first one is really around agriculture and the primary sectors. The real focus is to drive productivity and output. We want to make the region a net exporter of cereals, and for us to do that we need a lot more of tractors, mechanization taking place in Kenya and across the region.
Malahe made the remarks at the dealer's showroom in Nanyuki during a ceremony to hand over keys of a tractor to a farmer, Peter Getonga.
Nalimia watu mashamba, pia hata mimi nalimanga mashamba yangu mimi mwenyewe juu nausanga serious. Nitalima hata saidi kulingana na vile matarajio yangu iko. Equity Bank wamenisaidia sana kwa finance yenye wameniongezea pesa ndio nipate hii tinga. Juu kama ni mimi mwenyewe singeweza kupata hiyo tinga. Hii tinga thamani yake ni 2.8 ikiwa ina brown, kulingana hiyo loan nitakuwa nalipa 55,000 per month. Na mimi naona hiyo nitaweza kwa sababu wakati nilikuwa nimechukua tinga lori nilipa na mwaka moja na nilikuwa nalipa 50,000.
Sifao Managing Director Toyokio Kuno said the dealer supplies different sized case tractors, customized to different needs.
Equity Bank has been a long-term relationship partner with us. However, we wanted to, enhance our relationship with them and then to serve more to our case customers together with finance scheme up to 80%. In order for farmers to get the tractors, of course they need some financial backup.
Toyokio said use of tractors is necessary to minimize the risk of reducing yields.
Farmers, their income is based on their yield and crops. And then we are all exposed to temperature, climate. We really want to minimize that risk, increasing the productivity by using these tractors. We have set up our headquarters in Nakuru, which is heart of farming area, so that we can easily dispatch spare parts.
The Africa Recovery and Resilience Plan is really a plan to drive and transform wealth on the
us, and thank you for coming to Equity Group Holdings PLC half-year 2023 release of financial results. Before we start, allow me to welcome Bishop Dr. Charles Kariuki to open for us with a word of prayer. Bishop.
Thank you, Alex. Shall we pray? Our Heavenly Father, we want to thank you this morning as we gather in this place for investors briefing. We thank you so dearly for being there for us. And as we gather this time, we remember that it is by your hand and your grace that we are able to hold such a meeting. We thank you, Lord, for as we look back to our humble beginning, there were times, Lord, we could not have any report, but we see how far you have brought us. And therefore, as we gather this morning, we want to thank you with a grateful heart. We recognize that, Lord, it is by your grace and your favor that we have been able to walk this journey. We thank you for finding it pleasing before you to walk with us through valleys and mountains and to bring us to a place where you have given us a name among other names in this world. We bless you this morning and bless all of us who have gathered. We pray that in this meeting, may your presence be together with us. Give us a wonderful meeting, and at the end of it, may you receive all the glory. We thank you and we bless you, for this is our prayer in Jesus' name. Amen. Alex.
Let's appreciate Bishop. Once again, we want to welcome our investors, analysts, the members of the Fourth Estate. There are those who are following the live proceedings online. We are live on our Facebook and our website pages. For those who might have questions who are following us live, kindly ask your questions through the forums and we'll be able to respond to those questions. Allow me to take this opportunity to invite Dr. James Mwangi, the Group MD and CEO, to take us through the half-year results. Dr. Mwangi.
Thank you very much, Alex, and a very warm good morning to all of you. We are glad to host you as we release the first half-year results. And if we go straight to thinking through these results, we see these are results that have been reported or recorded during a very challenging global macroeconomic environment. We are all aware of the challenges the global economy is going through. It has not fully recovered from the COVID impact, the Russia-Ukraine challenge, the supply chain disruptions, particularly in terms of energy, cereals, and more importantly, fertilizers to support the agricultural sector. And as a result, that continues to cause strain on the supply side. As a result, the macroeconomic prices and indicators, one would say we are living in very turbulent times. The interplay between inflation, exchange rate, and interest rates really reflect a
a perfect storm where all the three economic market prices are reflecting challenges. And as a result, we see particularly emerging economies, their currencies reflecting volatility, significant depreciation, globally high inflation, or in all economies, irrespective of the status of the economy. And as a result, high interest rates as governments try to manage, to tame, and to smoothen inflation or impact that really affects disposable incomes among the populations. So this situation, as we can see, whether you look at US, UK, or the Eurozone, the numbers remain the same. Coming closer home, we see the government's all focused, concerted effort to manage this turbulence, and we see the focus on reducing deficits to really create physical buffers. Unfortunately, because we are coming from previous shocks, the buffers have been very thin, and as a result, there is a huge focus by all the governments in the region to manage deficits. And we see the very concerted effort giving us hope that we would eventually achieve a stable microeconomic environment. This has not detracted equity. We remain focused on the African Recovery and Resilience Plan, our strategy. And it's during difficult times that when you execute a strategy well, then it drives the transformation. So we feel a plan for African recovery and resilience is appropriate, and you'll see throughout the presentation that we have accelerated implementation so that we give the region an opportunity to keep, not only to keep the rights of the economies on, provide opportunities to the population, but almost also more importantly, partner with governments to get the recovery being realized faster. The involvement and engagement of an entire 300 million population in economic activities, using the social engine to catalyze change, to bring everybody to involvement, again shows the concerted effort that will be able to influence the direction that the region is likely to take. And that then gives us the interplay that we are seeing because of the effort of the group to execute, to sustain the resilient and recovery plan implementation. We see interest income growing quite fast at 27% because the group has sustained lending at 26%. And that's one would ask, how does a bank grow loans at 26% to earn 27% during such difficult times? It is simply because people require an umbrella when it is raining. You never take away an umbrella from people when it's raining. So we want to support businesses, we want to support communities, we want to support entrepreneurs so as to wade through this difficult and challenging time. And as a result, we see that the top line of the group has not been affected, consistently trading well. And as we can see, non-funded income growing much, much faster than interest income, suggesting the sensitivity of the group to bring affordability. And as a result, using non-funded tools, LCs, guarantees, letters of credit, as Frederick called them, to avoid exposing clients to interest expense. So that broadly is to support that top line. And that, if you do a bigger deep dive, you see trade finance is the fastest growing tool or financial tool to enable cross-border trade, again realizing the need to build local and regional value chains. And as a result, we can see trade finance, and we really can see at the national level, the country has reported a growth of 20% of cross-border African trade volume increase. And that maps very well to the initiative of the group to support the African Recovery and Resilient Plan, and particularly the cross-border trade. And really, this signifies the efforts of trade missions that the group has been involved in to really promote trade. As a result of that huge promotion of trade across the border, we see the treasury functions becoming very significant in the group. So it's treasury and trade finance becoming significant. We see forex income becoming a significant source of revenue because it's all about trade and trade within the region. And we can see, again, because of the macroeconomic environment, the yields on government securities have peaked up, and we see a 100 basis point increase in the entire yield of government securities. Again, looking at the trade finance aspect, the cross-border trade, we see the power of Equity Bank Kenya in driving that, then driving the growth of the subsidiaries. And we see that the subsidiaries, reflecting the geographical distribution, diversification, are now almost of the same size with Kenya. So almost 50% of the entire balance sheet of the group is now outside the Kenya banking subsidiary, which would likely be called the mother of this group. So the expansion has worked very well, and this has really placed the group very, very well, given that the subsidiaries are in the top 3 financial service providers in the countries they operate in. All 5 of the subsidiaries out of 6 are systemic, are in the top 3. And that again shows the capability of the group to support the regional trade. But looking then into the future, you recognize that this region, Eastern Central Africa, is the fastest growing region in the world. And as a result, when you have a systemic financial system in all the markets that constitute that region, it shows how well positioned the group is going forward into the future. If you look at the efficiency level of the group, it has been spread across the entire region, such that when the balance sheet contribution of the other subsidiaries other than Kenya is 46%, the contribution of the total revenue is at 45%, suggesting the efficiency of the processing and the speed at which the subsidiaries are becoming efficient, and that the subsidiaries are purely a reflection of replication of the Kenyan model. So there is not much difference. It's just scaling Kenya and its efficiency. The model is the same. That's why when subsidiaries contribute 46% of the balance sheet, they also contribute 45% of the gross revenue. And consequently, what you achieve, if it is the subsidiaries are exactly similar, it's a replication, then what you focus on is then the efficiency, optimization, and agility of an entire balance sheet. And that is where the future of this group lies, that you grow efficiently, optimizing and enhancing productivity. And we see the agility of the balance sheet very, very well positioned to be very, very responsive. And we can see the structure that creates a 51% liquidity of an entire group balance sheet. So reallocation to further opportunities becomes visible. We continue to register significant transformations using innovation tools, and we see the digital banking in terms of volume value handled. We are now on digital channels more than 2 times. Initially, we used to say low value transactions are on digital channels, but we now see that those digital channels are handling more than 2/3 of the entire volume of the group. So we continue to promote and build fintech capabilities, give alternative channels to our customers, a whole range of channels that enables customers to have choice, but more importantly, to meet the needs of different business segments. So this reflects the segmentation. But to an efficiency and cost structure, it means the group is quickly moving from fixed cost channels to variable cost channels to self-service channels. And so we could continue to see the same efficiency being unlocked going forward. And we see this as spread, including to lending. Substantially, there is a huge change in terms of the volume that is handled, other than just the number of loans processed and the fintech capabilities, the self-service. We also see the payments, the money transfer, huge volume being processed on these channels. Banking has become a 24-hour business. We have compressed distance, we have compressed time, and given people the ease, the convenience, and the freedom to their money. The integration with the global payment fintech capabilities again shows the readiness of the back end of Equity Group systems to be able to complete the transaction end-to-end. And we can see then as the country goes through the challenges of Forex, the group has been supported heavily by diaspora flows that has enabled us to keep the rights of the businesses of our customers on, providing them foreign currency as they require, and we can see the Forex trading income as a result playing a significant role in the structure of the entire income spectrum, and essentially contributing to enhancing the quality of earnings. When you look at the loan book, the way we have looked at the segmentation, we see the focus is heavily now on retail and micro, small, and medium enterprises, again, to support the value chains, to support ecosystem and to reflect a change in strategy to ecosystem banking. And so we'll see more and more of that shift, and we can see the corporate shedding of control from 41% to 39%, as we see retail climb up from 27 to 28, micro and small from 25 to 26. This is a huge balance sheet. You're talking of a balance sheet of 1.7 trillion shillings. So a movement of 1 percentage point in one segment is very important. But it's the structure of the economy that we are supporting. So when you look at diversification of the economic sectors, it means nobody is being left behind. It's a balanced approach so that builds the mitigants. And we see the impact of that diversification among economic sectors when we look at the asset quality. And we see that despite the very challenging environment, the group is able to register a 9.8% NPLs against a national average of 15%. So we can see the rewards of strategy that imbues diversification, helps to mitigate, but also the focus of our credit teams in supporting clients through relationship management to be able to manage portfolio. But as we can see, the group maintains resilience, prudence, and despite the fact that the quality of their own book is fairly strong, the group maintains strong provisioning policies to ensure that the cost of risk is taken upfront in compliance with IFRS 17 in terms of risk recognition. When we look at efficiency, we see a consistency, and as a result, we can see the yields on earning assets stepping up. But because it is global macro environment, we see the cost of funds rising much faster than interest income, again reflecting the environment under which we are operating as a group. The group continues to focus on social impact, shared prosperity, to continue to build the brand, to continue to sustain and uphold the trust that the group enjoys. And that trust that the group enjoys is really reflected by global rating and accolades that the group continues to receive, the recognitions that it continues to receive, the performance of the group from a statistical point of view, giving the group a significant role to play as an influencer in the financial field because of its performance. And we continue to play that role diligently, knowing the responsibility that leadership bestowed. And when you look at the quality that Equity Bank has become, you see how significant the market prices that quality of the bank. If you look, the bank has a market cap as of 24th July of 167 billion shillings, followed by the second closest bank with a market cap of 95 billion shillings, suggesting even if you add the second two largest banks, they are still smaller in terms of market cap than Equity Group, showing the premium the market is willing to pay for two things: the strategy the group pursue, the quality of the assets of the group, and the quality of the strategy of the group. So we have always emphasized that the greatest asset of this group is its people. This is where people don't appear on the balance sheet. But look at how much value, strategy, leadership, governance, and quality has been given. Equity Group is valued and priced higher than the two second largest banks in the Nairobi Stock Exchange. And when you look at, if we were to add the balance sheet, you'd see it has nothing to do with asset size, it's the quality of strategy and balance sheet. But that quality, which I would translate into trust, how much trust the Equity Group enjoys in the markets that operates, then is very well reflected by the growth the group is experiencing during very difficult times. So when I look at the balance sheet, the total assets of the group has grown up to 1,645 billion, a growth of 23% at a time the market is experiencing turbulence. And as we can see, that is not matched by profitability because equity doesn't focus on profitability. Equity focuses on changing lives, giving dignity, and expanding opportunities. And that seems to resonate very well with the market, and as a result, equity in very difficult times experiences a 23% growth in total assets or growth in balance sheet. When you look at what is driving that 23%, you see it's customer deposits at 21%. So it's like 1 for 1, the growth in customer deposits to the growth in balance sheet or growth in total assets. And that really reflects the trust, the confidence that Equity Group enjoys, the safe to secure place status that the group continues to enjoy. Earlier on, in the first quarter, we were talking about mark-to-market impact of the Eurobond. As we can all see, that has significantly reversed. And as I said, then that was a timing difference as you recognize this, and with that explains the growth of shareholders by 29%, because mark-to-market is normally netted off against shareholders. Funds doesn't go through the P&L, but that has reversed substantially during this quarter. Again, speaking that this balance sheet reflects the global macro environment in which we are operating. But what I wish to draw your attention to is that, well, equity has received increased funding by 23% during the period, nearly 300 billion. Most of that money has gone into loans, and that is why net loans to customers have grown to 26%. This speaks of equity's position, that you don't avoid the risk, you manage risk. So equity doesn't abandon its customers because the environment is challenging. It works with the customers to wade through a turbulent time and maybe to take advantage because of that support to position themselves. And that explains why net loans have gone up by 26%, because we feel we should never at any point in time detract our customers from their dreams. It's their dreams, we fund them, but manage the risks of the environment during that time. But the excess funding, as we can see, growing faster than the uptake by our customers on loans, has caused a growth of 33%, giving the group an opportunity to invest in government stock and government securities during very good times. Now, as we turn the page, I want to again demonstrate the parallelism that loans are growing by 26% and a corresponding growth in interest income when we turn to the P&L. But we quickly see interest expense is growing faster than interest income. There's always been arguments, why is equity increasing interest rates? Equity doesn't increase interest rates to increase profits. It increases interest rates because the market has moved. It's prudent management that you never undermine market forces. As we can see, interest expense has grown at 54%, 2 times faster than interest income. We're not trying to match any, it's not objective to drive, but it's to recognize the market prices of interest rates, exchange rate, and inflation. Those are the ones that you allow to play into your balance sheet, into your operations, reflecting the size of the group to allow transmission of monetary policy that the government adopts. When the government increases interest rates, gives 3-year bonds or issue 3-year bonds at 16 and 17%, it means that you can't undermine the sovereign risk rate of 17 by issuing interest rates lower than that, and so that reflects. But when you do that, then the cost of funds also reflects the sovereign risk rate. And so that explains why interest rates have gone up the way they have gone. It also reflects the global markets, where you have, as we know, equity has nearly 50% of its loan book funded in dollars. Again, it reflects the rise of the RIBOR from 0.25 to nearly 6%. So you could see 600 basis increase in cost of funding. And we see the prudence of the management as they navigate the growth in loan book. They want to continue to increase loan book, but recognize these are challenging times, and challenging times require prudence. And as a result, we see loan loss provision increasing by 89% as a recognition. Yes, we have very good loan book. It's remained substantially at 9% NPLs, but these are difficult times. So be prudent enough, make the right provisions as you read, recognize the risk, and continue reading, because we have made a commitment to the customers that we are in the business of intermediation. Business of intermediation happens all the time because customers are driving their dreams all the time. So essentially that explains. We also see staff cost growing by 32% on 2 accounts. Take care of your staff, then they will take care of the customers, but also strengthen the capability, the competence of management to be able to manage up. The group has grown by 23%, reaching nearly 1.7 trillion shillings, slightly above 10% of the GDP of the country. You need a competent, capable, experienced, and knowledgeable leadership team. And that rising cost explains the acquisition of such talent into the market. The 33% other operating expenses really reflects inflation. Inflation, as we have seen it, yes, it has started declining, but is still on the upper targeted number, above 7%, and that then reflects in the operating cost as people adjust. But inbuilt in this number is cost like imported inflation, reflecting the turbulence in the global market. And that gives us profit before tax of 35 billion shillings compared to 31 billion shillings last year, 30.9 versus 32.5, 35.2, a 14% growth rate. And we said that then if you look at that, and particularly when you apply tax, then you'll have a profit growth of 8%, 26.3 up for 24.4. And that's what we were saying. We really don't target profit. Profit is an outcome. We focus on serving our customers. We serve on doing what needs to be done, and that explains why the balance sheet grows by 23%, but profit after tax grows at 8%, almost a third of what the balance sheet is growing, because we want to fulfill our mission, we want to live our purpose, we want to strengthen our brand, and a brand is a promise kept. You don't withdraw an umbrella when it's raining. During challenging, risky times, you start with your customers. And that reflects a return on equity of 27% and a return on assets of 3.7%. Very impressive performance. So performance is not always looked at growth in profitability. It's what is the return on equity. Performance is measured in return of equity. So it means that for those who have invested in equity, despite the challenging times, their wealth has grown by 27%. And that really then reflects that maybe the best option in the marketplace, because even government is giving 17% in terms of treasury boards. Now, looking at the position of all that balance sheet from a regulatory point of view, we see efficiency in the way the yields on loans, government securities, and earning assets have continued to increase, so we are managing that macro turbulence very well, that the prices don't adversely affect and don't threaten the bank. So the yields, as we can see, there is an increase on yields on loans to 11.9 from 11.4, yield on government to 11.1 from 10%, and yield on interest earning asset from 9.7 all the way to 10.7, showing the sustainability of the model. It's difficult times, but the model continues to reflect the strength, it reflects the efficiency, it reflects the strategy that has been deployed despite the very steep cost on cost of funds and cost of deposits that we have seen almost doubling. And what we have preyed on is the ability. So it's not just the engine that is very efficient, but the buffers that financial institutions need to have during difficult times are at their best. We have seen the strength of management, the strengthening of the management with greater experience, knowledgeable people to help manage this, the environment, but we have seen the quality of the asset book, holding at 9.8% non-performing portfolio compared to average industry of 15%. We see strong NPL coverage, and we see the risk being passed through the profit and loss, cost of risk at 1.9, the prudence in management, while at the same time we see liquidity reflected by two numbers, loan to deposit ratio of 69.5, liquidity of 51%, showing the agility of the group to withstand prolonged shock. At the same time, we see core capital to risk-weighted asset at 15% against regulatory minimum of 10%. So we are registering capital buffers of 50% above the minimum capital requirement. So again, the ability to absorb shock, the ability to sustain growth of 23% or even faster growth is well inbuilt within the system. While total capital to risk-weighted assets start at 19% against a ratio of 14.4. So broadly 500 basis points over and above the capital requirement. Very, very strong buffers to support. The most fulfilling part of releasing these results is the knowledge that the management seems to fully understand this bank. They seem to understand the dynamics of the environment. So when you look at the guidance the group gave at the beginning of the year and the actual performance, the group is on track. So, and that is the simulation where I would say you simulate environment. So we had projected a loan growth of between 25 and 30. We're at 26. A growth of deposit of 20 to 25. We're at 21. Non-funded income of 40 to 43. We're at 43.5. Cost income ratio, we had projected 40 to 45, we're at 49. The effect, like we said, of inflation, the cost of staff, those are the two biggest drivers. But when all that is put together, equity has delivered on its promise of return of equity. It had projected between 25 and 30, and it has delivered 27.7. And cost of risk, that's what we could have maybe blown the promise, is high, reflecting the prudence. We had projected 1.5 at maximum, we're at 1.9. NPLs, we had projected between 7 and 10, we're 9 at 8. But the most fulfilling promise is subsidiary contributions, which we had projected between 45 and 50. We're at 46. P&L, or profit and loss, we thought subsidiaries would be contributing a maximum of 35. We're at 45, suggesting the subsidiaries has matured faster than we had thought. It's a perfect replication. Economies of scale are playing out. And so the more we see growth in the subsidiaries, the greater the momentum of profitability, because they are delivering above the target. The two strongest subsidiaries in terms, well, every subsidiary has done very well. We really appreciate the great turnaround that has happened in Tanzania. I want to draw your attention to Tanzania. Isabella, maybe Isabella, you could start. Isabella, 2 years ago, we invited her to come to recognize her. She inherited NPL, so non-performing loan book, of 36%. She's down to 16%. A huge transformation within a period of 2 years. Isabella, thank you very much. We really feel proud. We have also seen the momentum deposit growing at 30%. People say about Tanzania, that is the Tanzania we know ourselves. But I think the greatest contribution Isabella has done is really recruit very gifted, talented management that has not only managed to reduce NPLs, but to register very significant growth. We have seen Rwanda being the fastest growing of the old subsidiaries in profitability, balance sheet, Uganda being the fastest growing of all those subsidiaries. But as we had predicted, the outperformance have been by DRC. And DRC seems to be moving very comfortably, 60% of the balance sheet of Kenya and almost 50% of the profitability of Kenya. So DRC has come through beating all the expectations. But the new kid on the block, the insurance business, if we have seen, we thought the model was proven last year when ILAC, or Equity Life Assurance, registered a 68% return on equity after only operating for 9 months. We see this year that last year's performance have been delivered in 6 months, suggesting that we'll see better, much better results. And that is what has encouraged us, that seems the life business is stable, the model is tested now twice, we can go for general insurance, focusing a lot of health. And Ajara, maybe we could start. We really deeply appreciate this diversification on lines of business. Shareholders can see it, knowing that if there's challenges in banking, the insurance business. So we are seeing the insurance business, and our prediction, the way we predicted by 2027, DRC will be bigger than Kenya. There is a possibility insurance business will be bigger than the banking business by 2030. We seem to have got the model right, or we have got the right leader. Ajara, which is which? Both. We've got the right leaders, we've got the right model. The group structure seems to be doing well. And maybe, thank you very much, Ajara. And say, we have been kept on our toes by our risk group. Maybe I will ask the risk managers, our directors, starting with Sam, Wafula, Emmanuel. As you can see, the most seasoned bankers in equity are the risk managers. And they have kept, is Derma on the line? Cyber. We are also celebrating Charles. We all know the country has gone through very difficult times. I think the last 1 month of cyber attack and equity, we have been resilient, not giving way, and that resilience again is reflected by this very, very experienced team. But as we saw in the P&L, that team also comes with the cost. But for the customers, financial cost of staff is negligible compared to what Kenyans went through, customers of other institutions went through the last 1 month in terms of cyber. We are celebrating them that throughout consistently our systems have held when we are seeing the country under huge pressure from global cyber. So let me request you to help me recognize this team of very seasoned, highly experienced people. Wafula is in charge of control environment. Wafula in charge of compliance. We all comply with the rules. You manage risk by having processes and procedures. We recognize the credit risk. Emmanuel, you can start, Emmanuel. People see, we really are singing your places because of where you have, and Sam Kitwekere for the entire group risk framework. Earlier on, we said our largest income has come from trade. Where is Shemeka? Shemeka, thank you very much. 146% growth. 117. Thank you very much for correcting me. You don't want to take more than your share of credit. That's what you call integrity. So even when you give somebody, he'll say, no, 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 this is not mine. And we are seeing that with the customers. If you overpay customers, they are returning money. And that is really integrity at an enterprise level. Is Daniel Gashao in the room? Please start. That is the Treasury Department. They have really pulled through to manage a portfolio of $500 billion shillings. Treasury is managing government treasuries $500 billion shillings. And as we saw, despite the huge challenge, they don't have mark-to-market is declining. They seem to have managed their portfolio very, very efficiently, but more importantly, their returns or yields are 100 basis points higher. And again, we can see the future looks even better than the first quarter. So we can confidently say the second half, we hope and look forward to a better quarter. Thank you very much for listening. That's our presentation. But I'm with the team here, and as you can see, the other directors are here. We also celebrate Gerard, the managing director of Kenya. Those who may not know, we separated Kenya and the group, and Gerard went and set Kenya in Britam Towers. That's where they are located. This is purely the group. So again, we have seen that separation work very, very well. So where we are, this is a non-operating company. So for those who have always asked James, if you move out of business, what will happen? The business moved out of me. I didn't want to move out of business, but the business moved out of me. So Gerard went away with the business, but looks like we are still doing pretty well. So that is the dynamics that we have seen. Last week, we celebrated, because sometimes you have to say it, because if you don't say it, it hasn't happened. We sent 98 kids or scholars to 28 global universities. We took pride that Preston University, arguably the most prestigious university on earth, admitted 3, Harvard admitted 3, Yale admitted 3, and on and on and on. Out of 98 scholars, 18 of them went to Ivy League schools. So despite the microeconomic environment being very tough, we are still living to our obligation of investing in the future of our people, supporting communities. That 98 scholarships costed 2.5 billion Kenya shillings for the 4 years that those 98 kids will be out of the country. So again, we feel the partnership between equity and the public. Beth, maybe you could start, we recognize, but Dr. Beth Waweru leads the education pillar. Herself, she went to Yale. Looks like she has an agreement with Yale to support her with 3 kids every year. And thank you very much, David. Dr. Ayuka. Now, Dr. Ayuka has helped us a lot. We used to have 3% of our loan book being in agriculture. We now have 16% of our entire loan book being in agriculture. We want to catalyze agricultural transformation. This continent will not transform without a focus on agriculture, enable agriculture, make agriculture resilient, make agriculture sustainable. And they work very well with Leshma. Leshma, you could stand with our group director of sustainability, so that farmers are helped to adopt climate-smart methods to mitigate and adapt to climate change. And while the country is celebrating increasing food production, particularly of maize, from 41 million bags last year, 32 million bags last year to 41 million bags, we take pride that we have partnered with the government and played a very huge role to really secure food security for our people. And so hopefully by October, we'll lead better inflation because maize in the Rift Valley will have been harvested and will have started becoming maize flour. So this team of two has really helped us to position. Allow me to request you, we recognize their great contribution. Thank you very much and we can go into questions. Okay, the first question comes online, so let's handle the online questions. We have 4 online questions. Renak asks, why are we seeing such a significant growth in funding cost despite such liquid balance sheet? Very good. Ronak, we are seeing significant growth in cost of funding, 54% to be precise, compared to 27% growth in income, because the central bank rate has been increased to 10.5, but more importantly, because the government is crowding out the private sector by offering that 16 and 17% for 3-year treasury bonds. Human beings, owners of deposits, are rational, so they go where they earn most. And since we have given out loans, we have to continue funding those loans. Of course, then we match the government. That explains why the interest rates have gone up. We are excited that the government have pronounced its intention to reduce domestic borrowing, Brent, by 500 billion. Yvonne? $500 billion. So if the government pulls out from domestic borrowing, suddenly the interest rates will go down, and we'll see. The second aspect is that we have nearly 50% of our loan book in dollars. A year ago, this time, RIBOR was 0.2, margin was 4%, so we were paying 4.5% of the long-term loans. Those loans now, we are paying the margin of 4% and a RIBOR of 6%, which adds up to 10%. So that explains why the cost of running LONAC is growing fast, and it's what it is. You can't say because you are liquid, you not take deposit. You can't disengage from long-term debts. They are what they are. The penalties of early maturities will be very high. But at the same time, you don't know when the macros will reverse, and so you can't release deposit because you have loans that have already been funded. The underlying NPL formation seems very high, given the high cost of risk and increase in NPL ratio. What is the outlook for the rest of the year, given that it's trading above guidance? Mary, let me first of all correct. It's not trading above, NPLs are not trading above guidance. The guidance was 7 to 10, and we are at 9.8. But Mary, what is trading above is cost of risk. We are given a guidance of 1 to 1.5. It's trading at 1.9.
Thank you, James. And yes, Ronak, that is true. Our cost of risk is trending above guidance, but in light of the operating environment that we are operating in, and the fact that we are continuing to lend, shown by the growth in loans, we do need to be prudent in how we manage the loan book. We need to take up the risk up front. there is continued strain on our clients because inflation remains high, disposable income remains low, and that is likely to remain sticky for the next 6 to 12 months. In light of that, that ratio you're seeing of 9.8% is likely to remain sticky in that period, and because of that, we would like to keep our cost of risk high so that we take up coverage and make sure that the balance sheet remains safe. As much as it continues to grow at a very high rate, given the environment, we would like to maintain that safety. So the cost of risk will continue to trend above the guided range. It likely remain between probably 1.9 to 2.5% as we, pick up that safety. But we'd just like to highlight that in spite of this environment, we are at 9.8%, while the industry is at 15%. We are performing significantly better than the industry. So given that, we'd just like to also, given our defensive strategy, continue to pick up that safety of our balance sheet as what we promised investors.
So Gathia, it is prudence on one hand. The second one is strict application of IFRS 9, project the potential credit risk for the long or the lifetime of the loan, provide it today. But also we have been advised by our chief economist and our chief strategist that interest rates are likely to remain high. So they have used the word stubbornly high, and it's simply because inflation has refused to come down as expected. US, despite increasing interest rate from 0.25 to 5.5, inflation is still stuck at 3.5. So even if they pause or assume interest rates have peaked, it means they will not start lowering interest rates anytime sooner. So we are seeing this as a long, protracted challenge that we have taken a significant caution against. The third question, what is the deposit and loan growth in constant currency terms, excluding the impact of Forex devaluation? Brent, do you have that number? Sorry, Mike, Brent?
We'll get back to Ronak on those.
Okay. Maybe, Gadis, we can share that later. The fourth question, what is the profit before tax contribution of subsidiaries in constant currency terms? We would then compute that and share with you. I think we have finished the 4 questions that had come online. Very good, George.
I think throughout your presentation, I've been able to pick bits and pieces of what sustainability is at Equity. Please just codify it to me, just bring all those pieces together and give me 2 flowing paragraphs. Secondly, about your Africa Recovery and Resilience Program, with specific reference to DRC, every time you make pronouncements, you are revolutionary and impatient. How much are your partners able to keep up with you? And if they're not, what are the gaps?
Leshima, what does sustainability mean in equity? Give Leshima the mic.
So sustainability at Equity means really about underlying and supporting our clients build their resilience. It is about risk management, it is about value creation for our clients, and it is about making them sustainable for the future from an environmental and social perspective. And those are the key focus areas that we work on through the commercial side as well as through the Equity Group Foundation side.
George, it means that enabling the current generation of members to enjoy the gifts of nature without affecting the chances of future generation of members enjoying the same. So we have sustained nature, it's at its equilibrium, it's able to renew itself, it's able to regenerate itself, and so what your grandchildren will enjoy is exactly what you have enjoyed. You have your enjoyment of environmental gifts doesn't jeopardize future generations. It is true we are very passionate about the African Recovery and Resilience Plan. We have had very intense conversations with all development agents, including the World Bank, multilaterals, and asked them, share with us the development path and development plan that you have been pursuing for the last 60, 70 years. And what we have realized, there has never been an integrated African development plan. So it has been ad hoc. There has never been serious planning for development. And George, we then felt that failure to plan is planning to fail, and that explains why nothing meaningful has ever happened because of the massive resources being poured into the African continent to develop it. As a result, we said we believe we enjoy trust and we occupy a position of leadership, and we will exercise leadership, George, by providing thought leadership. And our thought leadership ended up with us developing the African Recovery and Resilience Plan. And because we enjoyed trust, we offered it to our partners, the Bretton Woods institutions, the UN group, the development banks, and we all agreed on principle and said, this is a good development plan that we can all put our hearts on the deck and hopefully through an integrated approach. If you look at what we call the flagship projects coming out of that plan, they are very transformational. When you look at today, pharmaceuticals in Uganda, it's a game changer. When you look at DRC, those who we went with in DRC and see all the global mining companies starting to add value in DRC, instead of seeding soil, they are now producing copper sheets, copper cathodes. When you look at the special economic zone that has been set to start the manufacturing of batteries, the manufacture of electrical cables in DRC, you see the leadership is playing. When you look at the focus on climate change, when you look at focus on agriculture, when you look at the focus in manufacturing, when you see a government like Ethiopia tripling its wheat production within a period of 3 years and becoming a net exporter of wheat, then you see transformation is taking place. When you see the area of focus, the East and Central African region becoming the fastest growing region on earth, then you start seeing this is not just talk, a lot of activities are happening. When you see the resilience of the East African economies, all of them registering above 5% GDP growth rate, then you see resilience is taking shape. So the passion is shared, George, and because the passion is in implementation. And we are very, very hopeful that this transformation will be sustained and that we are going to be the generation that will lay the foundation of the African Transformation Plan. When you see ability to get 98 scholarships to send 18 of those kids in Ivy League schools, then you see talent and future leadership being developed in a coherent way. When you put that into perspective and realize Equity has sent 854 kids in global universities. When you see 191 have finished schools in the US, and 47% of them are working with the big techs, then you'll see the acquisition of global capabilities, opportunity of transferring back the technology to the continent. So you start seeing it's not now hope, it's hope that has acquired legs, and the journey has started. When you see this, the trade, like Kenya saying, this year our regional trade has grown by 20%, you then see that the African Recovery and Resilient Plan is taking place. Joy, is there anything else you could like to say about the passion and enthusiasm? You drive this. Give Joy a mic, and maybe you could come in front so that you are looking at the camera.
Thank you, James, and for the question. Our partners, as James said, I think have been looking for a framework to come in and support. There are many activities and initiatives that are trying to support the development of Africa, but there really isn't a strategic framework. And this gives people and organizations something to quantify and measure their activities by, and to also see where the real gaps in development are. So they're not shooting in the dark, and they're not duplicating other people's efforts or other initiatives' efforts. So for us, the framework has served as a puzzle in some ways that people and organizations can come and play on. And we have found that they welcome that.
Thank you very much. I think when we look, George, at the invitation we made to business people to go to DRC last year, but one, which was followed by applications of $2.1 billion of loans to invest in DRC, it reflects again we are not alone. This year, we invited the global investors, analysts, and we took them to DRC. When you see the research notes that have come out of that, it really reflects the transformation is taking place. Who wants to take the second question? George, who do you want to take the second question? They have all been dealt with. Very good. So we are seeing huge. Waturi, is there anything else you could talk a little bit about what is happening in the African continental free trade area? You may want to look at the cameras.
Okay. I can report that there has been growth in intra-Africa trade. We are currently at 14.4%. I think we've had a number of initiatives, guided trading initiatives, with a number of countries being able to be supported by the Secretariat to Trade. And this is just basically to prepare the continent for the huge volumes of trade that are going to grow. There's a lot of movement, particularly between East Africa and Southern Africa, Eastern Africa and West Africa, and we continue to see that growth coming up. Thank you.
Very good. Emmanuel, the next two questions come to you, so maybe you could come and face the camera. The first one is the subsidiary's loan book seems to have grown much faster than that of Kenya. What is behind that? That's question number one. The second question, what is the interim impact of the purchase of specific assets and liabilities from Spire Bank to the business? Or is it too early to see the impact?
much, GCEO. To address the first question that relates to the subsidiaries growing much faster than Kenya, I think it's obvious that Kenya is now a matured business, and we are tapping into the potentials of the new areas or the new subsidiaries that we have just acquired. So you can see clearly that DRC, we have emphasized, and we are putting in a lot of resources in there in order to tap into the potentials that those new subsidiaries have. So that is why the GCEO also mentioned, maybe by 2030, we should be seeing DRC being the largest, basically surpassing the growth potentials of Kenya. The second question is on SPY.
Yeah. What is the interim impact of the purchase of specific assets and abilities from SPY Bank in the business?
On SPY Bank, as I explained the other time, we did that takeover because we don't want that impact of bad that really affecting the entire financial system. So it was a salvage strategy that we did. We had a lot of almost about 3 billion basically in NPLs, and we are seriously pursuing for recovery on those, and also looking at how best we can also reap something out of the securities that we have. So currently that is ongoing. We have a dedicated team that is looking at that, but it's too early to really comment on where we're going to be. But with the efforts we are putting in with that dedicated team, we are sure we'll be able to recoup a large amount of the bad debt that we have taken to save the financial system.
Thank you very much. Let me, Patrick, could you add my voice to that? As I said, the rescue of SPY Bank was purely primarily to play our role of leadership by protecting the entire financial industry. If you allow a bank to fail, what it does, it shakes public trust and confidence in an entire system, and we said we can create a rescue package around SPY Bank, particularly to ensure that it paid out all the depositors. What we were left with was a 3 billion non-performing loan book that Amala have said the first thing we did in prudence is to provide for it, and that explained this huge spike that we saw in NPLs. And then the second thing is put a plan for recovery, and we trust that we shall see this playing out as we go forward. But the good thing, the stability of the financial sector was assured. Second one is teachers who are the principal depositors in SPY Bank. They received all their deposits back, and that we have a challenge and an opportunity to strengthen our resolution of NPLs. Patrick Lushula, why has there been a drop in fair value losses on government securities, yet yields have gone up? I think, Brother Patrick, when we reported earlier on, the yields on Eurobonds were at 14%. As we reported this one, they were at 11.5%, and that explains the significant drop in mark-to-market losses on the Eurobond securities. Maria Jogona, as the board recommended an interim dividend. The board has not recommended an interim dividend. The practice of equity of the Board of Equity is to declare a final, last and final dividend at the end of the year, and it seems that they have kept up with the practice. Any other question on the floor? We have answered all. Very good. 3 questions on this side. Let's put the mics on this side, please.
Good morning, everyone. Thanks for the presentation. Two questions. Kindly give us an update on the Koje Bank acquisition, which was to be completed this month, according to the earlier shared tentative timelines. And second, kindly explain the dynamics behind the Equity Mobile application numbers, because the value is significantly up, over 50%, but transactions are lower. Is this in any way related to the reinstatement of fees? Or do you now bank bigger clients? Just to understand the dynamics. Thanks.
Very good. Gertrude, do you want to come forward and explain where we are with Koje Bank? Mary, do you want to explain the number of transactions has declined, but volume has significantly grown on mobile transactions? We can start with Gertrude.
Good morning, everyone.
Gertrude is our Chief Legal Officer and has been leading the initiative.
Good morning, everyone. Thank you for the question on the update on the Koje Bank acquisition. We have made progress with the transaction. On 28th of July, we signed the share purchase agreement. That agreement has terms and conditions that are customary, including regulatory approvals, competition approvals, resolutions of boards and shareholders on both sides. Right now, we are going through the process of fulfilling the conditions. There's a list of them, as is customary, and we're working through them as quickly as we can. We are also working closely with our regulators who need to approve the transaction. We're optimistic that we will get positive consideration from them. Our targeted completion date is 30th September 2023. We are working closely with everyone involved to see that we meet that deadline, and we will update you as we come towards that date. Thank you, James.
Thank you very much. Gertrude, Mary?
On the mobile app, you are completely right. That does have to do with the reintroduction of the fees. We have seen an impact when it comes to lower value transactions, which you see in the impact on volumes. But those who are transacting in high value transactions continue with that channel. So you'll see the values still go up, but in terms of volumes or number of people transacting, that has gone down. Yeah.
Pricing removes unnecessary transactions. Okay, there was somebody else there on that table, then we can come here. Let's.
Good morning,
thank
everyone.
you. Thank you, Bera, for understanding.
It's Michael Odundo from Standard Investment Bank. Just touching on here, I wanted to figure out what are your NPLs on your digital loan book. Given you had mentioned you disburse around 800 million a day, and we've seen a significant jump in NPLs quarter on quarter of around 17 billion. So I just wanted to figure out what's your NPL ratio on your digital loan book.
Mary, you got the question, please?
Yes, I did. When it comes to our digital loan book, we don't assess it from an NPL perspective because they're very short term. We look at it from a repayment rate perspective because they're 1 month loans, so they churn very quickly. On our digital lending book, we have a 98% repayment rate. So very little of that is leading to the contribution you're seeing to the deterioration. In fact, almost nothing. What you're seeing there is, you're right, about a 16 billion deterioration quarter on quarter was largely two big loans that are as a result of, can I say, change. One is change in government policy. It's a manufacturing entity. And another is linked to government contracts. They do construction contracts for the government, which again is the same deterioration that you saw in Q1. So digital lending does not at all contribute to our NPLs.
So as Mary has said, it's not a systemic portfolio deterioration, it's specific numbers that happens to be large. Yes, Bera?
Check. Morning. My name is Bala from Bloomberg News. I just want to know what's your plan for DRC. The top bank there is refusing to yield that position and is embarking on an acquisition strategy in that market, in other markets. So I'm just wondering what's your plan for that market and how do you plan to, for lack of a better description, topple the top bank there? Thank you.
Brent, The other question is, number one in DRC has refused to yield number one position. What is your strategy?
So our expansion into DRC needs to be looked at in the bigger context of what we want to do, especially with this Africa Recovery and Resilience Plan. You will notice that all our operations are within the East African community. Also importantly, all our operations are systemically important. That gives us a lot of competitive advantage against standalone banks in countries that we operate in. So for DRC, the principle is the same. There is an in-country opportunity where credit penetration is at 6-7% to GDP, and there's about 6-7 million bank accounts. This is in the context of a population of around 100 million people, a 50 million adult population. So for us, as much as market share is something we do look at, in a market that is under-penetrated, market share is not the key focus. For us, it's penetration. The allocation of capital, to your question on how peers, competitors are allocating capital, we continue to allocate capital in our existing markets. In DRC, we allocated around $75 million as we continue to see long-term opportunities in that market. So the focus, if we look at what we're doing and you're comparing us to our peers, what we are doing is focusing on penetration. For us, DRC is a penetration market. It's about acquiring customers. We believe we can get north of 20 million customers within a period of less than 10 years. And importantly, the neighboring countries in which we operate in, and we touched on countries like Rwanda, where we're busy doing an acquisition. We do operate in Tanzania. Tanzania is the only market where we don't necessarily have systemic impact, but it is a market that neighbors DRC. It is a market that has 8 neighboring countries where we operate in 4, one of them being DRC. Tanzania is also an anchor to the trade corridors that link DRC to the rest of the world. It's a market where, as James highlighted and as Isabella has demonstrated, we've been able to turn around from what is a challenging environment. It is now an environment that is very conducive to stronger growth. And this will have implications also for what we do in DRC. It also is having implications of what our customers are doing in terms of and also even our competition in terms of their regional expansion. So I think our principles of following the trade corridors is one of the reasons we find ourselves in East Africa. To Waturi's point, there is a lot of integration, increasing connectedness between our markets, and DRC is one of those critical markets that, with 9 countries neighboring it, you can't transform Africa without transforming DRC. So similar to Kenya, we will replicate what we've done in Kenya in DRC. In terms of customer acquisition, as we did in Kenya, we have a mobile-driven strategy as well. We have agency banking. As much as we have a corporate book, the intention is to drive our ecosystem approach to gather the SMEs and build out these value chains. And as you've seen with what we've done in insurance, we will look to replicate what we're doing in banking as well as in insurance across all our markets. So hopefully that gives you a sense of what we're doing, and you can contrast that to our peers.
Thank you very much, Brent. I think there is another question here. Christine, you are a lawyer, so make the prerogative. And the question you have been asked, what is the status update on TransCentury? Mine was to caution you.
Okay, thank you very much, James. And good morning, everyone. So I think I'll focus on what has been published in the press, and I'll stick only to that. We are currently, as you're aware, the entire group has an exposure of close to 9 billion to Equity Bank. And this is constituted in 3 entities: the TC company itself, the group, East African Cables, and Civicon Limited. As you're all aware, we did put TC into receivership, and East African Cables, we appointed an administrator. This has been suspended. It has not been lifted, so we're currently in court. We are trying to find a way to ensure that legally we're able to go back and have both the receiver and the administrator reinstated. We are waiting for a ruling in the coming weeks on this matter of the injunction. But the point still remains, and for those who have been able to follow the court process, that the debt is outstanding and the debt needs to be paid. Thank you.
Thank you very much. I think the last question is anonymous at D, and the question is, what could the growth in the balance sheet have been, assuming a constant exchange rate between Kenya and US dollars? And we said we would need to compute that. That question had been asked earlier. We couldn't get the answer on the spot. And we had said Brent and Merin Tere would be willing to take that. And maybe during the investors' call in the evening, we may have that answer. And what could the balance sheet grown has been if reporting was US dollars? It's the same as the other way around. So we'll provide that data. You can talk to Brent and Merin Jenga and see what the answers will be. Any other question? Yeah.
Good morning, everyone. First, to begin with, is to congratulate the equity management team. Again, they have been quite efficient in delivering growth and also, again, in managing the business. So I have 3 quick questions. Let me introduce myself. Sorry for that. My name is Franklin Warohio from Abojani Investment. I'm a financial analyst. So my first question definitely is on the total cost. Again, Equity has reported a high profit of 26.3 billion for the half year. But again, looking at the total cost, they have grown by 38% to 46.9 billion. And again, these total costs definitely there is the operating cost and also the corporation cost. They are quite high, and currently they are becoming a concern for many corporations or even for many organizations. And also the cost to income has currently or even stood at 49%. And with provisions stood at, if you add the provisions, it stood at 57.6%. Like Dr. James said, the net interest expenses are growing faster than the net interest income. So my question is, what is Equity Group doing to reduce these costs? That is my first question. My second question definitely will go, or even is about the subsidiary performance. The subsidiaries contributed 45% of gross revenue and 46% of the profitability to the group. Yes, and close to 50% of equity balance sheet is Equity Bank outside Kenya. So what is driving the growth of subsidiaries? I remember the last time we were here for the financial year 2022, Dr. James Mwangi said that one of the things that was driving growth of the subsidiaries was the organic growth of the East Africa economies. And also today he noted that East African economies are the fastest growing economies in the world. So what is really driving the growth of the subsidiary performance, considering again Equity Tanzania, Equity DRC performed quite well for the half year? My third question is on the low NPA ratio. Again, Equity has a low NPA ratio of 9.8 compared to its peers and also compared to the average of the industry average of 15%. So my question is, what is Equity doing different from other banks to maintain the NPL ratio quite low compared? So many banks are struggling with the non-performing loans. What is Equity doing different compared to other banks? And then my final question definitely is on, again, I wouldn't like to conclude or even without asking a question on return on equity or even ROE. The ROE definitely stood at 27.7% in half year 2023. But again, important to note, it is a decline from 28.9 that was reported in June 2022. Again, this doesn't mean that Equity's management is not efficient. I know Dr. James Mwangi and the team are doing all it takes, again, to increase shareholders' value. But again, it is quite important to note that decline in return on equity, despite the net profit growth of 8% to 26.3 billion. What is Equity's strategy to increase shareholders' value for the financial year 2023? That is my final question. Thank you.
Thank you very much. Huge 4 questions. Let me try, and then colleagues, whoever feels they can add a few. The first one is on growth of subsidiaries. Why are the subsidiaries growing that fast? As you said, the first one is that we have become very successful in replicating ourselves, the model. That's why you see we registered as number 18 in Uganda, and we are now number 3 largest bank. Organic growth, substantial. It has demonstrated our ability to really replicate the model, the relevance of the model, the strength of the model. That's one. So it hopefully will follow the same path that saw Kenya move from number 66 out of 66 to become number 1 or number 2, depending on what parameters you do. So it's really a replication of that, a very relevant business model, appropriate for our region, an inclusive model, a shared prosperity model. It speaks a lot about the model and execution capability, but also it now reflects the efficiency of execution, a speed of execution. It took us 32 years for Kenya to move from technical insolvency number 66 out of 66 to number 1 or number 2, whichever parameter you are looking. But it's taking us, it took you as Uganda 16 years to move to number 3. It has taken Rwanda 12 years to move to number 2, and DRC has taken us 7 years to move to number 2. The second thing is that it demonstrates that this group has been very successful both at organic growth and mergers and acquisition. DRC is a story of buying 2 banks, merging them, and creating a systemic bank, number 1 or number 2, depending on the parameters you look in DRC. So the question of competence, capability of leadership, strategy, success of strategy, relevance, appropriateness of our business model, but more importantly, our ability to address the market needs. As Brent earlier said, in DRC, for instance, credit to GDP is only 7%. It can go all the way to 100. The headroom is very, very significant. Inclusion is at 6%, suggesting we can still access 94% of the population. So that has contributed to, but you are right, if you look, and I liked the way you framed the question. You are systemic between number 1 and number 3 in South Sudan, Uganda, Rwanda, DRC, and Kenya. Again, reflecting that this is everything to do with model, it is everything to do with strategy, it's execution capability, it's leadership and competence there. The second question is growth of cost. And we said 89% of the growth is on provisions, speaking to prudence. Do you want to reduce prudence? Maybe no. So we would really like to recognize the risk in the marketplace using IFRS 9. We would like to be prudent in managing the risk so that we sustain the quality buffers that we have. The second question is the staff cost growing at 32%. Do you want to reduce this? Maybe no. You'd like to focus on productivity. How do you increase productivity? How do you increase the same skills and competencies that has guaranteed us all the good things you have said? So these are the strategic drivers. And you don't disrupt strategic drivers. What you do is focus on productivity. You optimize on the cost that you are incurring. However, there is one cost that we are working very hard on, other operating costs, which have grown by 34%. We'd like to address that. That has a lot to do with inflation, transmission, whether it's imported inflation or not, the consumptions or from the bills of the suppliers. And broadly, that is the opportunity we have. Focus on efficiency, focus on productivity, value addition, and cost optimization. So there is a huge room there. And lastly is a cost that doesn't reflect heavily correction. And you heard what Christine Brown said, we focus on default loans to recover depositors' money. So a very aggressive approach, consistent approach in recoveries. And that asked the next question of NPLs. The message that Christine was talking about is a clear message to all borrowers that when you borrow from equity, you should be prepared because it's depositors' money to repay your loan. So when you are firm, people read you well, you create an organization culture on how you manage debt. So we could say it's the organizational culture that is paying. It's the signals and the incentives we have sent to the market, how we deal with the defaulters firmly, because it's depositors' money. We have no leeway to give depositors' money, so we seek to recover depositors' money. Our business is intermediation, take from those who have excess and give to those who have deficit, so we enforce recovery as much as possible. But if truly we were to speak about equity, the reason why this has been consistent, it speaks on the governance structures in equity. It speaks on the governance practices in equity. And I will invite maybe Sam Kitwekere to say one or two things, and maybe as I finish. And lastly, his return on equity has come down from 28.9 to 27.7. While we don't celebrate decline, we celebrate the achievement that not even the government can be able to give that type of return. Not even deposits can give that type of return. It's very premium return. And you can see the appreciation of the market. When you look at the pricing of equity in the Nairobi Stock Exchange, it's trading at 0.9. The average of the banking stock is trading at 0.4. That gives you an insight as to how this return of 27.7 sits with the investors. But it's our commitment to do what it takes to give all the stakeholders an opportunity to maximize value. So as we get back to efficiency, as the macro environment change, we'll see a reversal of this trend, like we saw the reversal of the mark-to-market numbers. Yes, Sam.
Thank you. Thank you, James. Thank you, James. I'll touch on governance from two perspectives. Number one, corporate governance. Number two, risk governance. Corporate governance is about complying with the expectations of the Companies Act, meeting the expectations of our key regulators, the Capital Markets Authority, and the central bank and others. Separately, there is risk governance. As you know, the Central Bank of Kenya holds the board of directors responsible for risk management. The board of directors delegates those responsibilities and authorities to management to execute certain actions and activities in line with policies approved by the board of directors, in line with the strategy approved by the board of directors. So the board of directors delegates. Risk governance is the spells out or describes the process by which the board is kept informed and is able to track what is happening across the organization. To facilitate risk governance, the board approved an enterprise-wide risk framework. The enterprise risk framework spells out roles and responsibilities for risk management across the group. So it sets out roles and responsibilities for a first line of defense. These are the teams in our organization that deal directly with customers and have responsibility for various processes and businesses, and are focused on generating revenue for the group. The board of directors also delegated responsibilities to a second line of defense, whose responsibility is to provide oversight over the first line activities, ensuring that they are conducted within the policies, the risk appetite, limits, and so on and so forth, approved by the board. And the second line is responsible for reporting to the board. And finally, a third line of defense, which is internal audit, that provides oversight over the activities of both the first and second line of defense and provides reports to the board. Secondly, the board of directors approved risk appetite statements covering our 16 principal risk types. So in equity, we recognize that our top risks could emerge from 16 principal areas, including some of those that the GCEO has spoken to today: credit, capital, liquidity, market risks, but they also include non-financial risks such as operational risk, fraud, cybersecurity risk, compliance risk, financial crime risks, ESG and climate risk, and so on and so forth. 16 of them in total. The group has appointed individuals to lead the management of those risk areas. We refer to them as risk framework owners. Their responsibility is to publish frameworks that set out how those risks will be managed, utilizing people the leadership that the Group CEO referred to, enhancing our processes and investing in systems, and reporting to the board on how this process is working. So in a nutshell, the enterprise risk management framework is focused on the roles and responsibilities across the 3 lines of defense, focusing on managing our top risks and evaluating continuously to see how all the changes taking place across our top risks, focusing on staying within appetite for all business activities, and finally keeping the board of directors informed. Thank you, James.
Thank you very much, Sam, for a very elaborate answer. Mary, what was left out by Sam on governance?
Thank you, James, and good morning, everyone. Thank you for joining us today. So Sam has covered quite a lot of what we say is a very solid and sustainable platform that we have built, where we anchor our business on a very strong governance platform. And we look at the governance from very many aspects. You heard Reshma talk about the ESG component of it. That has become very, very central to our operations now, because we feel it is very critical and also very important to give us that sustainability and allow us to grow as much as we want. Now, one thing that we have focused, and this also goes towards one of the questions that Franklin asked, why our subsidiary is doing well, is because we have focused a lot on building the structures. That is where we start. And I can say that we have learned a lot of lessons as we built Kenya, because Kenya is where we tested the business model. And we realized that if we got very basic items, like building a strong culture of the organization, then everything else rests on that, on a very solid basis. And Tanzania, for instance, that's the first thing we focused on. And we asked ourselves, do we have the right people? Are they doing the right thing? And we have the MD who has been doing nothing else other than just get the right people on board and get them to do what they need to do in accordance with the policies, and of course look at the market, understand the opportunities, and then of course we supported them from the group. We have strengthened our support from the group in what we are calling the matrix reporting structure, where every counterpart is supported from the center, and business is able to move, they're able to resolve and brainstorm on issues, troubleshoot where they need to do that. And that seems to be working very well, because the teams on the ground are very well supported by the teams at the center. And we believe that that has helped us to boost the businesses across the region. And then, of course, finally, I would just want to talk about board oversight. In all the subsidiaries, we have been strengthening the boards. So the oversight from the board is something that we are keeping on reviewing every day, and we are very happy that our boards have been supporting us just to make sure that the right oversight is being provided to the management teams on the ground, the right questions are being asked as and when necessary, and of course the necessary support is also given. Sometimes it also requires policy lobbying, especially in some of the countries where we feel we can do better on regulations, we can do better on policies and all that. And that teamwork seems to help us in terms of growing the businesses very fast, but on a very solid and very sustainable platform. So I think I would say that is where we are focusing on, and we do appreciate the support of all the stakeholders who have been able to support us in different capacities. Thank you, James.
Thank you very much, Mary. And last but not least, the man who is operationalizing this strategy, Chief Operating Officer. Same questions, growth of subsidiaries. Why are they outperforming Kenya? The subsidiaries you oversee, what the growth of cost What is your promise? Are you going to be able to bring efficiency, economies of scale, to promise a lower cost outlay for the second half? And we want to take then the impact on return on equity and also on NPLs from where you sit. Sam Kerobe.
Thank you, Group CEO. Good morning. I'll pick from there, and a number of lessons have been learned, and Group CEO spoke about the lessons learned in Kenya, what we've done better in terms of greenfield and the acquisitions we've done, but beyond that, the frameworks, risk management framework that Sam spoke about. So the diversification in the subsidiaries comes in with economies of scale from technology. So the expansion is not just brick and mortar from customers acquisition, the product offering, it becomes beefed up by the role of technology that we are doing, particularly in DRC, in Tanzania, but also being fortified by the business lines, equity insurance, that becomes an addition. In addition to that, we've also formed a very strong product house, which becomes a very efficient shared service for all subsidiaries. That means product development, we're able to do risk by design, security by design, and controls. So the growth for subsidiaries will come in a better, efficient way, speaking to the return on equity and the ROA so would promise a better half going forward. Thank you.
So maybe we could recognize the directors of the product house. Those who are in, you can stand.
I would see Lene.
Lene is not in the house.
Radia.
Okay, they don't want to be introduced, so it's okay. Next time. You want to introduce yourself? I'll give you the mic. Then misses an opportunity.
Thank you, Dr. James. My name is Olusegun Amaniwa. I'm a product director for investments and safe products within the Equity Group. I joined the group about 6 months ago after spending about 15 years working across different markets for Standard Chartered Bank. Thank you.
So that hopefully, Makome, anything that would have been said from a commercial perspective on these 4 questions? Growth of subsidiary, cost structure, NPLs, and return on equity. Dikrai.
Thank you, James. I think almost everything has been said.
Maybe you could come in front so you face the camera. Give him a better mic. Come on this side.
Yeah, thank you, James. I think everything has largely been said. What I would say from a business perspective is that the growth plan, as you ask about the subsidiaries, is very, very deliberate. And Brent talked about the Africa Recovery and Resilience Plan. And the business teams are organized in such a way to have a balanced delivery of that plan across all the subsidiaries. If you look at one of the key pillars and our first pillars is around agriculture and extractives, and we do have a director of agriculture, and more importantly, our focus on the DRC is about extractives. When you look at mining, the main subsidiary that's currently delivering the mining space, about over 90% of our mining book is in the DRC. So when you ask why is the DRC growing, there's a very specific emphasis and focus on mining and value add in mining in the DRC. So the contribution from every particular subsidiary is very, very specific. It is deliberate, and we are ensuring that we are not just delivering in one particular country like in Kenya, but that all the other subsidiaries are delivering what they're supposed to deliver. So I think it's very, very deliberate, the fact that we expect a lot more coming out of the subsidiaries. And the other thing about Kenya is that it's a much bigger market. So if you see a 10% growth in Kenya, you might think it's small, but the base is very, very huge. So a 10% growth in assets in Kenya is actually likely to be bigger than a 20-30% growth elsewhere. So sometimes you may be deceived by the percentages. Kenya is also contributing a substantial growth to our book. Thank you.
Before you sit, Patrick Kithongo asked, how are you partnering with Kenyan companies that would like to grow in DRC? Are there forums available to share insights about DRC and tips on how these firms can grow in DRC?
Okay, thank you. We have had quite a number of excursions or actually business trips to the DRC. This year we have, as Equity Bank, we've been involved in 2 of them. We went with the Kenya Association of Manufacturers, who are the sponsoring bank for that trip, which happened in July. We went with quite a number of companies, and we are tracking. We have a mechanism for tracking that every single company that was there was being supported. Just last month, again, we were in the DRC with a major investment trip. We went with, I think, some investors. We went with the international investors. We also went with Kenyan investors. We visited quite a number of companies and had a lot of forums, both in Kinshasa and also in Lubumbashi. We are following up on the actions from those trips. Actually, as a matter of fact, yesterday we had a review meeting just to look at the lessons learned and what more support we can give. One of the things that came out of that discussion is how do we keep this discussion alive? What more can we grow? What can we learn? Actually, we've had quite a number of trips. Even last year, we had a major one. What we are doing is getting the lessons learned and ensuring that we are able to support all the people who are interested in the DRC. We're even coming up with a booklet, actually a guide, so that we can assist those companies even more. And so we are continuing to learn.
But Patrick Rongo is asking, are there forums available to share insights about DRC? Tips on how these farms can grow in DRC? Yes, it's Joy.
Yes, Joy. Yes, we do have webinars, but we are improving more and more forums to ensure that we do pass all the lessons and support people who are interested in the DRC.
So maybe, Patrick, they are not able to be very specific. You can contact either Joy or Makome. You get the specific, how to get to those forums. Patrick is interested in being included. But the answers you have given him, he doesn't know how to be included. How does he get included?
He can get in touch with us. We will include him.
Give him your number.
Okay.
How will he get in touch with
I'll
you?
give you a number. Actually, we even have a WhatsApp DRC forum, but he can take my number, which is 0763-248-550. Anybody interested in the DRC, get in touch with me on that number.
Again, the number again?
0763-248-550.
Thank you very much. Makome is our Chief Commercial Officer at the group, so he deals with all market issues. I remember Yuka recognized you for really supporting us, monitoring, evaluating everything we are doing, but I gave you the credit of Leonardo Luco, who is the Director of Agriculture. Daktari, maybe it is good you wave. That is the Director of credit, as you heard. Both the doctors, they seem to have names. One is Ayuka and the other one is Oluka, so a mix-up. I apologize deeply, and I deliver the credit on agriculture to you. Thank you very much. With that, seeing no other question, I want to take this opportunity to thank investors, analysts, for the state, and shareholders for coming up this morning, being with us. Chemi, you were raising your hand when we have closed. Last one. I saw you in DRC. Do you want to share your experience of DRC?
Yes.
Yes. Okay, share the DRC. Maybe you could come in front so that...
Let me come here.
Yes, come here, next to Madam Mary.
Oh, yeah, Madam Mary, my sister. Doctor, sorry. Good morning, everybody. Ladies and gentlemen, shareholders, analysts, and management. Now, Doctor, let me assure you that we are really supporting you in investments in this year, DRC. What we saw in DRC was very pleasing, and I think there will be a lot of growth in future. The environment is good, the climate is good, the people there are quiet, and they are very happy about seeing Kenyans, not Ugandans, not Rwandans, because those are on war, but Kenyans who are making their business there are very happy. We talked to them, they talked to us, and they said continuation of Kenyans in DRC will make DRC grow, and Equity Bank will have to grow very fast, even better than in Kenya.
Chemi, what would you recommend the Kenyan business people with a focus to DRC to focus on? What is the most...
the most business they can do.
What you saw, the biggest opportunity?
The biggest opportunity there are hotels, hotel makers, there are people, importing their wares, importing vehicles, importing these hardwares.
So it looks like it's everything.
Yeah, there's everything there. So in fact, your wisdom, let me thank your wisdom. Your wisdom is so good that you went to DRC, and you also made us go to DRC. Some shareholders are here. They are there. They can also support me in that. But we are assuring you that our support is overwhelming.
Thank you very much, Chemi.
Among all the MDs in Kenya, on the stock exchange, I think you are number one to me. Thank you.
Thank you very much, Chemi. Alex, back to you. Thank you very much.
Thank you, Dr. James Mwangi. Can we appreciate Dr. Mwangi? So once again, we want to thank all of you for joining us as we released our half-year results for Equity Group Holdings PLC. The results will be on our website page, and the conversation, like Dr. Mwangi has said, for the analysts will continue in the afternoon through the investors call. Kindly continue to engage with us, and for the members of the fourth estate, as you walk out, you'll have a copy of the press release and the copy of the investors booklet. Thank you. Breakfast will continue, but allow me to invite Bishop to close for us with a word of prayer. Thank you for joining us today once again. Bishop.
Thank you once again, Alex, and let's bow for a word of prayer. Everlasting Father, we want to thank you once again for the good and wonderful meeting that you have given us. We want to thank you and bless your holy name as we recognize your grace and your favor upon us as an organization. For us to have the results that we have just released, we know that it has costed you and your hand. We are not better than the others, but we want to thank you because you have chosen to take your glory in what we are doing from the vision that you gave us right from the beginning. We do thank you so dearly, and we don't take it for granted when we have such results, growing and registering that percentage of growth and figures in a time of turbulence and uncertainty. We know that that can only happen if God of heaven, the Creator, is in our midst. So we do want to thank you and bless you. What more can we say to the honor, the favor that you have shown us all along, other than to give you thanks with grateful hearts? We bless you and we thank you. Even as we move on, we still put our hope and trust in you. We know we have strategy, we have aspirations, and we're moving forward. But we anchor all these unto you, who is all able and all powerful. We thank you for your preeminence, and we're looking forward even to getting to higher dimensions because we have put our trust in you. Those who recognize you and the help that you give, which is so divine above every natural help, they are never ashamed in their efforts. So we bless you and we thank you. Thank you for the leadership. Thank you, Lord, for our shareholders and investors. We thank you even for all our customers. How we pray as you bless us, may you extend these blessings to all these stakeholders and together help us to move forward. More importantly, as we impact lives and livelihoods of your people. We thank you for this investors briefing. And as we come to the end, how we pray that you bless us and let your peace continue to prevail in our land, in the region, that we may continue doing what you have called us to do. We thank you and we bless you, for this is our prayer in Jesus' name. Amen.